Well, you just wonder whether that jump in the oil price, though, will change the inflationary expectations of the Reserve Bank when it makes its latest interest rate decision tomorrow. Markets expect after 10 consecutive rate rises, they'll be left on hold. But the fight against inflation clearly is not over yet. So let's bring in here Warren Hogan, independent economist and an advisor to the small business lender Judo Bank. Warren, as always, thanks for your time. The Reserve Bank may leave them on hold. What do you think they should do, though?
Well, I think they should go 25 basis points. The data is continuing to print reflecting an economy that's still got a lot of momentum. And, of course, the inflation numbers last week were off a little bit, but there's nothing new in that. We know that inflation's peaked. But it's about it coming down quickly, and it's not coming down quickly. Well,
the annual inflation monthly print is 6.8%. The cash rate is 3.6%. So even if you took a 1% off it and it was 5.8%, you could argue it's still a long way away from where the cash rate is. That's the issue for the Reserve Bank.
We've got deeply negative real interest rates. That is interest rates minus inflation. And as you can see here, this is a shorter-term momentum of inflation. That is the 4-month changed annualised, and you can see it's only just drifting off. Inflation is not collapsing. It's not free falling. And, of course, the other one there's rents. Rents is in the CPI is everyone's rents, but we know that advertised rents are increasing more like 10 or 15 or 20%, depending on which market you're in around the country. That will filter through to the CPI. Inflation isn't in free fall in this country. There is no assurance it's going back to target quickly. And I think they still need to take out a little bit more insurance by raising rates tomorrow.
OK, but then what the Reserve Bank has done is pushed out its forecast of when inflation will get back to its 2 to 3% band. It's pretty easy to sit there and go, oh, well, it won't be this year, it might be next year, or it might be the year. That's the guessing game. That's the problem. That's part of the reason why the Reserve Bank review is underway and in the hands of the Treasurer right now.
Yeah, look, to that point, though, the Governor did say in his speech after the last meeting, in the Q&A, he said that the inflation coming back to target in early 2025 is as far as they can tolerate it. They can't keep pushing it out. I mean, the proof will be in the pudding, but that's as much tolerance as they've got. And there's nothing that's happened since that tells us it's happening any quicker. If anything, all the risks point to inflation remaining sticky. And, of course, we're seeing that overseas. In the US, inflation sort of seems to be stuck in the high 4s, 5%, very high. So I think that they really have got to get on with it.
OK, do you want to know the reason why I think they're going to actually keep the rates on hold tomorrow? And that is because the Governor is addressing the National Press Club on Wednesday. Of course, this is where he controversially didn't do that and went off and did the Barrenjoey briefing earlier this year and got into strife for that. He's now doing this on Wednesday. Now, normally he doesn't go and do those types of things unless there's some sort of a change in the policy or the message. My gut feel is that there's a change in the message, and that's the reason why I get a sense they're going to keep them on hold tomorrow.
Well, look, I think whether they raise by 25 points or raise by 15 basis points, they could do that, or hold it. The message on Wednesday is going to be the same. We're pausing now. And I totally agree with that. I think there's enough in the system. I'd like to see one more 25, but they're going to send that message. They're going to sit and watch all through our winter. And, you know, a lot of people are going to read that as a peak in the rate.
But to your point, there's one other aspect of this. That is, there's no necessary push on wages at the moment, but the ACTU is coming with that at 7% that they want, and the government's following with inflation. And then you've got job vacancies, because still there is this problem at the moment that there are lots and lots of job vacancies out there.
This is the data that came out last week that isn't getting talked about enough. Job vacancies measured by the ABS, down 1.5% in the 3 months to February. As you can see from the chart, down 8% from last year. But more importantly, they are miles above their long-run trend. That is 40-odd years of history. The pandemic has given a huge shock to this economy, and that is essentially excess labour demand out there. So there is two things to read here. One is these wage risks remain in the system. The other one is the unemployment implications of slowing the economy down are not going to be as bad as they would have been in the past. That is, if someone loses their job in one business that might get it tough, they can find a job.
They generally should be able to find another job, which means that the stresses on households will not be as great if interest rates continue to rise to change their spending habits and behaviour.
Exactly right. They should be more confident that the effects of higher interest rate are not going to be as significant on unemployment as in the past. And I think that's very different to the narrative. Everyone thinks the economy is about to hit the wall and fall over, whereas I'd say that interest rates are still very low and we've still got a lot of inflation in the system.
OK, so the messaging is going to be very important over these next few days for the Reserve Bank and for the Reserve Bank Governor. And yet sitting in the hands of the Treasurer right now with 51 recommendations, which you presume are not recommendations to keep things the same, is this review into the Reserve Bank Board, and that could change the very nature of the way in which interest rate decisions are made in the future.
I think they're going to see some big changes in the way the RBA operates at the very least. We've talked about that. I think the really important point is whether or not they're going to change what the RBA targets. Are they going to change the inflation target? Are they going to broaden the mandate? That's going to make markets, investors, overseas investors all very nervous around this. I suspect they won't, but we're going to wait and see.
So just tell me one last thing. As they go, say, for example, you say they should go tomorrow, then pause. They don't go. How many more rate rises are there before you reach a terminal rate? We're obviously closer than what we were at the start, but how many more are needed to actually get all these things you're talking about under control?
I do not see Australia as being materially different from our peer economies. The United States, Canada, New Zealand, they are all got interest rates around 4.5 to 5. I think that's the end game here if we don't see a major financial event.
Warren Hogan, always good to have you in the program. Many thanks for your time today.